Hello everyone and welcome to Talking Trusts. Today I'm joined by Richard Aston from the CC Japan Income and Growth Trust. So Richard, thanks very much for joining us.
Thank you.
Perhaps to get started, could you talk a bit about what the trust invests in? And I know Coupland Cardiff, which is where you're working, is also a sort of specialty manager for Asia. So could you talk a bit about that as well, please?
Yeah, well, CCM is an independent asset management company focused primarily on Asian equities. Fund managers all have long experience in the market and run very concentrated alpha generating portfolios.
Great. And can you talk a bit about the trust as well? So what is the sort of goals of the trust? What do you invest in?
Yeah, the trust was established in 2015. The goal was really to capture what we saw as a very exciting and quite unique opportunity, I think, that was emerging in Japan with regard to distribution of capital to shareholders through dividends and share buybacks. Great.
And I think whenever we have discussions internally as a company with the analysts, or if you dare to read the FT comment section, I think you tend to find from some people this sort of skepticism about Japan. It's sort of, the index is still below, I think, the all-time high it hit 30 odd years ago. And it's sort of this place that people are often optimistic about, but it's somehow their perception is it doesn't necessarily pan out. So what would you say to someone who is maybe a bit skeptical about Japan? What do you think it offers that is so attractive?
Yeah, we feel the skepticism is somewhat outdated actually now. Certainly relevant, as you say, from when the market peaked in '89 through to around about 2010. But from there, if you look at the returns on the market, they've been very strong and they've been very consistent. It's actually been a good place to invest. If you look at the distribution of dividends over that time frame from 2010, it's been much stronger and much more consistent than other equity markets. So we do feel now there's strong justification for looking at Japan as a genuine place to invest.
Great. And I mean, as I think you've touched on there, the strategy is very focused on income, so dividend payments. Do you think there's something about Japan particularly that makes it suitable for that strategy or for that objective?
Yeah, we do. Yeah, I mean, Japanese companies historically hadn't paid a huge amount of attention to shareholders. It's only been the last few years where we can really say there's been a clear emphasis from companies and also from initiatives taken by the government to promote shareholder distribution. And companies are in a strong position to do that. They have very, very healthy balance sheets, net cash in many cases. The dividend cover is very, very high, and that has allowed companies to deliver the strong profile of the last few years.
Okay, so Richard, you touched, I think in your answer already a bit on some of the changes that have been taking place in Japan over the past decade or so. And I think for most people with a passing knowledge, that would probably be, they would have heard the term Abenomics, but they might not necessarily know what that really means or what those changes are in more tangible form. So could you talk a bit about some of those changes? What has happened in more meaningful terms that you think has made made Japan a more attractive place to invest?
Yeah, former Prime Minister Abe introduced a wide-ranging program to help Japan restructure and reform, the Abenomics that you refer to. There was a very, very important component in that from our perspective, which was a goal really to encourage companies or push companies to improve cost of capital, improve their corporate governance, and I think as a consequence of that, improve their shareholder return. And we've seen sort of tangible evidence of that with successive years of record dividend payments and record share buybacks.
Great. So are there any more changes, do you think, afoot at the moment? I think in your most recent update, you talked a bit about this, and for anyone watching, I would recommend having a read of those of the monthly updates that CCJI puts out, just because you don't just get the raw numbers, you get some insights as to what's going on. So can you talk maybe a bit about those changes? What's coming up that you think might sort of build on what's already happened?
Yeah, it's an evolving process. We see there are initiatives taken by institutions, the government, etc., that are really promoting a continual improvement. I would highlight current Prime Minister's objective of doubling the income from financial assets. That clearly places an emphasis on asset owners or asset holders to demand more income from their holdings. And that'll have a very, very important focus going forward over the next few years.
Great. And so if you look at the CCJI portfolio, the majority, I think, is in dividend growth stocks. That's what you sort of categorize them as. But you have about 10% in what I think you describe as special situations. So can you talk about what that means? What are those special situations?
Yes, we have a very disciplined approach to investment, disciplined approach to valuation. And we're looking to invest in companies that have at least a 5-year track record of improving their distribution through dividends primarily. In the case of special situation, we sort of waive that historical requirement for 5 years of growth. This is a period of change, and we believe if we can capture companies at the point of change, then we will be rewarded for that. With the belief really what's coming in the next 5 years is far more important than what's happened historically. Okay,
and so when you invest, I mean, this is a bottom-up process, right? So you're not picking themes or trying to make macroeconomic calls, as far as I understand. Mm-hmm. But do you see, as a result of that process, any themes or sectors, that sort of thing, emerge that you think are worth highlighting or think that investors would find interesting?
Yeah, I think because of the characteristics that we look for, we are maybe biased towards particular sectors that we believe have long-term justification. We are looking for companies with strong balance sheets, good growth prospects, that's very, very important, and an awareness of shareholders. If we look at the portfolio in a broader context, we can identify companies that are global leaders, companies that are very, very strong in their chosen field, companies like Shin-Etsu, global leading manufacturer of silicon wafer, also PVC. There are companies that are very strong in Japan, but are using that strength to benefit from the growing economies of Asia. They're very, very close geographically. Companies like Novia, cosmetics manufacturer, is a good example, leading skincare brand in Japan that is extending its reach beyond the shores of Japan into other parts of Asia. And also we're looking at domestic opportunities as well. The demographic profile of Japan is well understood, but despite that, there are still areas of the economy that are growing. Job recruitment is one area because of mobility that is increasing in the labour market, and we have exposure to companies like DIP and Japan that are key in that industry, are leaders in that industry.
Great. So are there any sectors that you look particularly to avoid as well? We obviously keep an open mind, but we're very dependent really on the characteristics that we believe drive long-term performance. There are some sectors that really don't demonstrate those characteristics. So areas like steel and shipping, very, very cyclical industries that arguably don't generate profit over a cycle, are areas that we currently have zero exposure. Okay, well, I think most people watching will probably be aware that it's been quite a volatile 12 months. So has that provided any opportunities for you to add to the portfolio? And also, can you maybe talk a bit about how the trust uses gearing? Because I think that's something that we see investors being a bit wary of at the moment.
Okay, yeah. Volatility creates opportunities for us, and that's something that I think we can identify over the last 12 months. We do have a very, very disciplined approach to valuation. So there have been stocks that we've followed for a long period of time whose fundamentals we like, but have traded too expensively. The volatility of the market over the last 2-3 years has created opportunities to invest in companies of that nature that we like. So an example is Zozo, Japan's leading online fashion retailer, a company that has grown substantially over the last few years. Valuations fell quite notably during the last two years, and we were able to establish a position in a company that we like very much from the long term. With regard to gearing, we actually have a structural gearing of 20% in the portfolio, meaning that we run the portfolio with that 20% gear position at all times. There are two reasons we feel we can justify that. Firstly, in the short term, it allows us to increase the income generating capacity of the trust, which we think is a strong selling point, by that 20%. So that's very, very important. Over the longer term, and this is equally important, I think that we can show that even in the periods where the Japanese market fell, there were a number of companies whose share prices had continued to rise over that time, and the characteristics that were evident and consistent were companies that were growing, had strong balance sheets, and were distributing consistently to their shareholders. So the gearing over the long term is also beneficial, we believe, to shareholders. Obviously, in the short term, with market volatility, there may be times where that isn't the case, but we do consider it to be a long-term benefit.
Okay, so the strategy of the trust is to buy and hold. What can investors expect performance to look like? I mean, over sort of 12, 3, 5-year periods?
Hopefully we can avoid some of the volatility that we've seen in markets recently. We're not exposed to the extremes of value or growth that seem to have dominated shorter term performance. We're focused very much on the long term and the characteristics of those companies and the ability of those companies to distribute consistently to shareholders. And if you look at the portfolio, you'll see that the companies have done that, even though some of them face some difficulties maybe in 2020 during the pandemic. Okay,
great. Well, perhaps to finish off, could you provide viewers with just some thoughts on what you think is likely to be happening in Japan this year and perhaps a bit beyond that as well?
Yeah, I mean, I think the shorter term opportunities in Japan are actually quite exciting as it emerges from its own pandemic restrictions. There has been a slight dislocation in comparison to other parts of the world, and Japan is now benefiting, I think, from a pickup in the domestic economy from both the domestic population returning to normal, but also finally foreign tourists being allowed back through the borders of Japan. So there's certainly a short-term opportunity, but really it's the long-term that we consider to be most important and most exciting. The structural changes that we've alluded to are continuing. Companies are still in a very, very strong position, healthy balance sheets, good dividend cover, and presenting us with many, many investment opportunities.
Fantastic. Well, Richard Aston from CCJI, thanks very much for joining us. And for anyone watching, if you'd like to learn more about the trust, just head over to the CCJI website. As I said, I really recommend looking at the fact sheets. Alternatively, you can find a research note on the trust on the Kepler Trust Intelligence website. So thank you again for watching, and we'll see you next time.